Most traders see the RSI drop below 30, and they instantly think it's oversold and rush into a buy, only to watch price fall even further and hit their stop. That doesn't happen because the RSI is wrong. It happens because nobody explained what these levels actually mean or how to read them the way real traders do. So in this video, I'm going to make the RSI clear, visual, and easy to understand for you. Open TradingView with me for a moment. Look at your chart, then go to the top, click on Indicators, and in the search bar, type RSI. Click on Relative Strength Index. You'll see a new window open below your price chart. Now focus here. You'll see one purple line moving up and down. That purple line is the RSI itself. It's measuring the strength of recent price moves between 0 and 100. On top of that purple line, you'll see one yellow line. That yellow line is just a moving average of the RSI. It smooths the RSI so you can see if momentum is stabilizing or turning. You don't have to use crossovers or any complex signals right now. Just remember, purple line is the actual RSI. Yellow line is the smoothed RSI. You'll also see horizontal levels on this RSI window, usually at 30, 50, and 70. These three numbers are very important, so I'll explain them in a clean, step-by-step way. First, understand what RSI is doing. It's not trying to predict the future. It's simply telling you, right now, who is stronger, buyers or sellers, and how strong are they. When the RSI is around 50, it means the market is balanced. Buyers and sellers are almost equal. There's no clear strength yet. When the RSI pushes towards 70 and above, it means buying strength is very high. The market is strong to the upside. When the RSI drops toward 30 and below, it means selling strength is very high. The market is strong to the downside. Now let's break this into the three zones you care about and what you should actually do there. First, RSI below 30. When the RSI falls below 30, it's telling you the market has moved down too fast and sellers are in extreme control. This area is called oversold, but that word is very dangerous because people think oversold means price will go up now. That's not true. Price can stay oversold and keep falling. So if RSI is below 30, my first rule is simple. I don't open new sell positions because most of the move is already done. At the same time, I don't blindly buy just because it's oversold. What I do instead is mark that area and watch. I wait for the purple RSI line to start turning back up, and I want to see price slowing down near a support level on the chart. This zone is not a buy signal. It's an early warning that the down move is getting tired and I should prepare, not rush. Next, RSI between 30 and 50. This is the recovery zone. The market is coming out of that oversold condition, but buyers are still not fully in control. Imagine someone who just finished running. They are standing, breathing, but not sprinting yet. When RSI is moving from 30 up toward 50, it simply means selling pressure is fading, but buying pressure is not strong enough yet. In this range, I stay patient. If I was in a sell from earlier, this is where I think about taking partial profits, because momentum is no longer as strong, but for new buys, I usually wait. You'll see a lot of choppy price action here, small bounces, fake moves, sideways ranges. So between 30 and 50, my focus is to read structure. Is price forming a higher low? Is it building a base? I don't want to jump in just because RSI is rising. I want proof on the chart. Now, the most important part, RSI above 50. When the purple RSI line crosses above 50 and stays above it, that tells you buyers now have more strength than sellers. Think of the 50 level as a line in the sand. Below 50, sellers still have the upper hand or momentum is weak. Above 50, buyers are winning the strength battle. This does not mean buy the second RSI crosses 50. It means from this point, it makes more sense to look for buying opportunities instead of selling. So what do I do when RSI is above 50? I go back to the price chart and look for real entries. A higher low, a break and retest of resistance turning into support, or a clean bullish structure. If price is showing a bullish pattern and RSI is holding above 50, now the strength and the structure are aligned. That's where trades make much more sense. And what about the 70 level? When RSI goes above 70, it means the move is very strong, not automatically wrong. Trends can stay above 70 for a while, so I don't jump into a sell just because RSI touched 70. I only prepare for a possible pullback if I see RSI bending down and price slowing or forming a double top. Until then, above 70 just confirms strong bullish momentum. Once you start using RSI like this, as a strength meter, not a magic signal, your decisions become much more logical. You'll know when to avoid chasing, when to stay patient, and when the market finally has enough strength on your side. In upcoming videos, we'll go deeper into advanced RSI ideas like RSI divergence, RSI trend line breaks, and RSI rejection patterns that can catch reversals with much more precision. Tell me in the comments, which RSI strategy do you want me to cover next? Divergence, trendline breaks, or rejection at 70 and 30? This video is for educational purposes only. I am not a financial advisor. Trading involves risk, so always do your own research before making any decisions. Charts shown in this video are from tradingview.com.